Hey everyone, welcome back to the Crypto Code. A lot of people still believe Bitcoin is one of the most volatile assets on the planet. It's something far riskier than stocks or tech, but when we actually look at the data today, that belief no longer holds up. Let's talk about it. Before we jump into today's topic, we want to remind you that here at the Crypto Code, our goal is to provide you with the top news, research, and tips when it comes to finding projects with huge profit potential. Stay to the end of this video and learn how you can earn $10 in Bitcoin and a free weekly trade alert just for attending one of our free workshops to learn more about who we are and what we do. No purchase needed. Our trade alerts have a 93% win rate, so make sure you take advantage of this free alert. Remember, I am not a financial advisor. This is not financial advice. So do your own research before you make any crypto trades. Okay, so Bitcoin has quietly changed. In the early years, extreme volatility made sense. Liquidity was thin, institutions weren't involved, regulation was unclear, miners and supply shocks played an outsized role in price action. Small changes could move the entire market. That environment is gone. Bitcoin today trades in deep global markets. ETFs removed access and custody risk. Regulation is clearer than it's ever been. The supply schedule is fully known and already priced in. As those risks disappeared, volatility came down with them. Here's the part most people still haven't adjusted to. Bitcoin is now calmer than many high-growth stocks. In some periods, it's been less volatile than names like Nvidia. That might sound crazy, but only if you're anchored to the past. This matters because institutions don't just chase returns. They look for three things working together: strong upside, lower volatility, and lower correlation to traditional markets. When an asset starts delivering all three at once, it becomes extremely attractive for portfolios. That's exactly why institutional demand continues to grow. Now let's talk about the 4-year halving cycle. A lot of people treat it like a law of nature, as if Bitcoin must follow it forever, but the 4-year cycle was never guaranteed. It existed because of specific conditions. In the early days, supply shocks mattered because supply dominated everything. Liquidity was small, capital was limited. Halvings had dramatic effects. Today, institutional flows dwarf miner issuance. Bitcoin's supply schedule is public, predictable, and widely understood. It's no longer the main driver. What matters more now are bigger forces, regulatory progress, institutional adoption, liquidity conditions, currency debasement, and government spending, and trade imbalances. Those forces don't operate on 4-year clocks. They play out over long time horizons, and that's why we're likely shifting away from sharp boom-bust cycles and toward a longer structural trend higher, with volatility compressing over time. And that doesn't mean no pullbacks. Shakeouts will still happen. They always do. But institutions don't think in months. They think in decades. They already missed Bitcoin going from dollars to thousands. Many couldn't buy. Others didn't understand it. Some were blocked by reputational risk. They don't want to miss the next 10 years. That's why we see steady buying even during 20% or 30% drawdowns. For long-term allocators, those moves are noise if the long-term thesis remains intact. Now zoom out to crypto more broadly. One of the fastest growing real-world use cases isn't speculation, it's stablecoins. Stablecoins enable near-instant global payments for almost nothing. They give people in high-inflation countries a way to preserve purchasing power. Adoption is exploding in places like Argentina, Nigeria, and Mexico. This is one of the fastest growing areas in all of tech, yet valuations still don't reflect that reality. Of course, growth brings resistance, and as stablecoins become large enough to matter, governments will push back. Countries facing capital flight won't blame currency mismanagement, they'll blame the escape valve. That tension is coming, and when it does, it won't stop adoption. It will confirm how powerful this technology has become. And the final piece is tokenization. When regulators openly talk about stocks and assets moving on-chain, that signals a major shift in financial infrastructure. Institutions want to build there, but they need durable legal clarity. If comprehensive market structure legislation passes, it becomes an all-clear signal. Capital markets measured in the hundreds of trillions begin moving on-chain, and in that world, today's valuations for leading blockchains make very little sense. So when people ask whether crypto is too risky heading into 2026, the better question is this: do you think Bitcoin is moving into a long-term, lower volatility phase? Or do you believe the old boom and bust cycles are still in control? Drop your answer in the comments. We're genuinely interested to see where everyone stands on this. Thanks for watching the Crypto Code. If you found this video helpful, please like, subscribe, and hit the notification bell for more crypto insights. Let me know your thoughts on today's video in the comments below. You can also check out what we do here at the Crypto Code by registering for one of our free workshops where we show you how we and our students profit in crypto no matter if the markets are up or down. If you register for the workshop, you also get access to a free weekly trade alert. Attend our free workshop, take a short quiz at the end, and we will send you $10 in Bitcoin. No purchase needed. We have already given away hundreds of thousands of dollars worth of Bitcoin just this year alone. Just look for the link in the description of this video to register for the workshop. It will be worth your time. Our public trade record currently has a 93% win rate, and you can view it here. Best of luck with your investments, and remember to stay informed and stay safe in the crypto world. See you next time.